The vaults are nearly empty and nobody is talking about it. Today is Saturday, April 18th, 2026, and while the financial media is obsessed with Trump's unverified peace deal and the collapse in oil prices, a far more dangerous crisis is unfolding inside the COMEX warehouse system. As of Friday's close, the COMEX registered silver inventory, the only category of metal available for physical delivery, has dropped to just 76 million ounces. That number alone should terrify every paper silver holder, but here is the part that turns this into a systemic emergency. There are currently 571 million ounces of open interest contracts claiming that metal. Do the math. The COMEX has enough physical silver to cover exactly 13.4% of its paper obligations. For every 1 ounce sitting in a deliverable vault, there are 7.5 people holding contracts who think that ounce belongs to them. We are now officially below the critical 15% coverage threshold that marks the boundary between a functioning exchange and a full-blown liquidity crisis. And starting this week, May delivery is active, which means contract holders can now demand their metal. If even a fraction of those 571 million ounces show up asking for bars, the COMEX will face a force majeure event that could freeze the entire global silver market. Let me give you the historical context for why 13.4% coverage is an existential threat. During the 2020 COVID panic, COMEX silver coverage dropped to around 28%, and the exchange came within days of a delivery default. Premiums on physical coins and bars exploded to $12 over spot. Dealers ran out of inventory. The U.S. Mint suspended production of silver eagles. That was at 28% coverage. We are now at 13.4%, which is less than half of that crisis level, and the May delivery window just opened. In January 2026, during the height of the Iran war panic, we saw delivery demand spike to 7 to 10 times normal levels as institutions scrambled to convert paper into metal. If that pattern repeats in May, the COMEX will simply run out of silver. There is no plan B. There is no emergency stockpile. The registered vaults are the last line of defense, and they are 86% depleted relative to the paper claims stacked against them. Silver closed Friday officially at $79.60, but in the after-hours shadow markets where large institutions trade directly with each other, prices spiked to $81.55 and briefly touched $82 per troy ounce. This shadow price is the real price, the price that sophisticated buyers are willing to pay for immediate physical delivery. The $79.60 you see on your screen is the paper price, the price determined by speculators trading contracts they have no intention of ever converting into metal. The gap between these two prices is widening, and that gap is a flashing red warning that the paper market is losing its ability to suppress the physical reality. When the COMEX opens Monday morning at 6 a.m. Eastern, we are either going to see a violent gap up as the market reprices to reflect the vault crisis, or we are going to see a coordinated intervention by the bullion banks to smash the price down and scare off delivery demand. Either way, the 13.4% coverage number is the nuclear bomb sitting under the entire silver market. The drain on registered inventory is not a recent phenomenon. It has been accelerating for months. On January 1st, 2026, the COMEX had approximately 88 million ounces in the registered category. By the end of February, it had dropped to 82 million. By the end of March, it was at 79 million. Now, in mid-April, we are at 76 million. That is a loss of 12 million ounces in less than 4 months, which represents a 13.6% decline in deliverable inventory. At this rate, the COMEX will hit zero registered silver in roughly 136 trading days, which puts the doomsday date somewhere in late September or early October 2026. But that is assuming the drain continues at the current pace. If May delivery demand is even moderately elevated, that timeline collapses to weeks, not months. Now let's talk about what May delivery actually means, because most retail investors do not understand the mechanics of the futures market. When you buy a COMEX silver futures contract, you're not buying silver. You're buying a promise that you can convert into silver on specific delivery dates throughout the year. May is one of those active delivery months. Starting this week, anyone holding a May contract has the legal right to stand for delivery, which means they notify the exchange that they want physical bars delivered to a vault of their choosing. Historically, only about 5% to 10% of contracts actually demand delivery, because most traders are speculators who roll their positions forward or close them out for cash. But in January 2026, we saw that percentage spike to 40% to 50% as the Iran war created panic demand for physical metal. If we see anything close to that in May, the COMEX is finished. Here is the nightmare scenario that keeps the COMEX clearinghouse up at night. Let's say 30% of the current 571 million ounces of open interest decides to stand for delivery in May. That is 171 million ounces of demand hitting a system that only has 76 million ounces available. The exchange has three options. Option 1, declare force majeure, suspend physical delivery, and settle all contracts in cash at the current paper price. This would be an admission that the COMEX is a fraudulent system and would likely trigger a global run on every paper silver instrument, from ETFs to unallocated accounts. Option 2, allow delivery to proceed on a first-come, first-served basis until the vaults are empty, and suspend further deliveries. This would create a two-tier market where early claimants get their metal and everyone else is left holding worthless paper. Option 3, intervene with the bullion banks to smash the paper price down so violently that it scares contract holders into rolling forward or selling out rather than taking delivery. This is the most likely outcome, and it is exactly what happened in March 2020 when silver briefly dropped below $12 per ounce despite massive physical shortages. The difference between now and 2020 is that the retail stacker community is far more educated. People have seen the premiums. They have seen the out-of-stock notices. They have watched silver hit $121 per ounce in January and then get smashed back down to $71 with no corresponding improvement in physical availability. The trust in the paper market is gone, and when trust is gone, price suppression becomes exponentially harder to maintain. If the COMEX tries to crash the price in May to shake off delivery demand, they risk triggering the exact opposite reaction. A buying frenzy where every price drop is met with increased physical demand from stackers who know the real story. Let's also examine the eligible category, because there's a lot of confusion about this. The COMEX reports total silver inventory as the sum of registered and eligible. As of this week, total inventory is approximately 327 million ounces, with 76 million registered and 251 million eligible. The mainstream media loves to point to that 327 million number and say, see, there's plenty of silver, but that is a lie. Eligible silver is metal that is stored in COMEX-approved warehouses, but is not available for delivery against futures contracts. It is privately owned, and the owners have not made it available to the exchange. It is like saying your neighbor's car is available for you to drive, just because it is parked on the same street. The only silver that matters for contract settlement is registered, and that number is 76 million and dropping fast. There is also growing evidence that even some of the registered silver is not as available as the official numbers suggest. Reports from industry insiders indicate that a significant portion of the registered category is already allocated to specific industrial users under long-term supply agreements. Companies like Samsung, which is using silver in solid-state batteries, and major solar manufacturers have standing contracts with refiners and distributors that guarantee them a certain amount of metal each month. That silver shows up in the COMEX registered totals because it is physically in a COMEX warehouse, but it is effectively off limits for futures delivery because it is already spoken for. If this is true, the real deliverable inventory could be closer to 40 or 50 million ounces, which would put the actual coverage ratio somewhere around 7% to 9%. We are in uncharted territory. Now, let's connect this vault crisis to the macro environment, because the May delivery crunch is happening at the exact same time that the Federal Reserve is entering a 12-day blackout period, and the US dollar is collapsing. On Friday, the DXY fell back to levels not seen since February 27th, the day before the Iran war began. When the dollar was at these levels in late February, silver was trading between $93 and $95 per ounce. Today, with the dollar at identical levels, silver is only at $79.60. That is a $15 per ounce pricing error. The only reason silver is not already at $95 is because the paper market is artificially suppressing the price through speculative, short selling, and ETF liquidations. But that suppression only works if the physical market remains liquid. The moment the COMEX runs out of deliverable metal, the paper price becomes irrelevant, and silver will reset to whatever price is required to clear the physical market. Based on current premiums at major dealers and the $4 premium on the Shanghai Gold Exchange, that price is north of $100. The Kevin Warsh confirmation hearing on Monday, April 21st is the next major catalyst. Warsh is Trump's nominee to replace Jerome Powell as Fed chair, and his hearing comes at a moment when the market is pricing in aggressive rate cuts. The CME FedWatch tool shows a better than 60% probability of a June rate cut, with year-end rates expected to fall below 3.5%. If Warsh signals a dovish outlook during Monday's hearing, the dollar will break, Treasury yields will plummet, and silver will gap higher. That gap could easily push silver through $85 and trigger a wave of stop-loss buy orders from short sellers who are betting on a price decline. If that happens, while May delivery demand is elevated, the COMEX will be caught in a vice between rising prices and falling inventory. The exchange will have no choice but to either suspend deliveries or allow the price to run to whatever level is necessary to discourage physical offtake. China's record imports of 206 tons in the first 2 months of 2026 are also draining the global supply pool. That metal is being pulled out of Western vaults and shipped to Shanghai, where it disappears into state reserves. The Shanghai Gold Exchange is paying a $2 to $4 premium over COMEX spot, which creates a powerful arbitrage incentive for anyone who can source physical metal in New York or London. The result is a one-way flow of silver from west to east, and that flow is accelerating, not slowing. Every ounce that leaves the COMEX system reduces the available inventory for May delivery, tightening the noose around the exchange. Industrial demand is also relentless. The World Silver Survey 2026 confirms that we are in the 6th consecutive year of a structural deficit, with global consumption outpacing mine production by approximately 67 million ounces this year. Since 2021, a cumulative 762 million ounces have been drained from above-ground stocks. That is more than an entire year of global mining output simply gone. The deficit is not going away. Solar panel production is accelerating as governments around the world double down on renewable energy mandates. Electric vehicle manufacturers are adopting solid-state batteries that require 10 times more silver per vehicle than traditional electronics. AI data centers are being built at a record pace, and each server rack contains silver-intensive components. The industrial floor under silver demand is rock solid, and it is rising every quarter. As we sit here on Saturday, April 18th, 2026, the COMEX has 76 million ounces. May delivery is active. Open interest is 571 million ounces. Coverage is 13.4%. The dollar is collapsing. China is hoarding. And the Fed is silent. Monday morning is not just another trading day. It is the day the market finds out if the COMEX can survive its own math. The institutions know the vaults are empty. That is why they forced retail to sell ETFs for 7 straight days, clearing the decks for a move higher. The smart money is positioned. The question is, are you? This is the hidden ag, and the truth is in the vaults, not the headlines. I will see you Monday when the delivery notices start coming in, and the world finds out what 13.4% coverage really means. Stay physical.